So the question I think we need to ask ourselves is, have those valuation falls stopped? Have values stabilized? And do we see a time when they might rise again? So what do you think? Within the Consulco group, we're now looking very carefully at commercial property opportunities both in London and provincially.
Welcome to the Investment Spotlight, London edition, which is a new Consulco podcast series where we explore and analyze investment opportunities in the UK with industry experts. Today, we're speaking with David King, who is the head of UK real estate at Consulco and a veteran property fund manager with over 35 years of real estate experience in London, the rest of the UK, and Europe. Hi, David.
Isabella, good afternoon. Welcome
afternoon.
to London.
David, first question for you. Can you outline the UK's economic performance post-Brexit and post-COVID, and what has contributed to its better-than-expected outcomes?
I think before we look at what's happened in the last 2 or 3 years, we have to go back to the Brexit vote in 2016 and the infamous Project Fear, which those who were anti-leaving the EU perpetuated. And at that time, all of the industry analysts were expecting a huge UK recession. That never happened. Now, of course, since then we've had COVID, during which the UK suffered perhaps the worst recession of Western economies, but bounced back strongest. And I think there are 2 reasons for that. Firstly, the consumer sector has held up incredibly well. And as you know, in the UK, we have a big consumer sector. Secondly, wages have also held up well. We've got very low unemployment, much lower than the rest of Europe. And the combination of wages, strong employment figures has meant that the recession that was forecast never happened.
What are the growth forecasts for the UK economy compared to other major European economies?
I think it's a good question because, we've looked back, now it's time to look forward.
Right.
And it's clear that all of the Western economies and much of the world, to be honest with you, are facing a period of uncertain GDP growth, and the UK is no different. What we're looking for in the UK is muted growth over the next 3 years, but some growth. So in the first half of this year, we had a GDP growth of about 0.2 or 3%, and we're expecting the same in the second half of this year. That's important because it means that the UK will not have gone into a recession, unlike, for example, Germany. Moving forwards, the Bank of England expects low GDP growth, but growth in 2024, 25 and 26. So a slowly growing economy.
That's fantastic news.
I think it is, because obviously with the economy growing, that will assist the property market, which we'll come on to in the future.
What is the near future outlook for interest rates and its impact on investment, David?
Oh gosh, Isabella, well, we've had a real shock on interest rates over the past 18 months or so. As our economy came out of COVID, we were hit by massive supply side issues, as were many Western economies as well. And our central bank reacted to that and the pressure on prices with high inflation by increasing interest rates. And we've got now the highest interest rates since 2007. Looking forwards, we are all hopeful that we are towards the top of the interest rate cycle and that there may be 1 or 2 more small increases in the base bank rate, but that from Q2 next year, we should see those gradually reducing over time. We can't deny that it's been a difficult 2 or 3 years, and the dramatic rise in interest rates has had a knock-on effect in the real estate market, which we'll come back to again as we go through this chat. But the good news is, as I said, we're towards the top of the cycle and looking forward now to it reducing gradually over time.
How has remote work and COVID-19 impacted London's commercial real estate, especially in areas like the City and Canary Wharf?
So I think COVID accelerated 2 main trends, 2 important trends that were probably happening already. So the first, which we'll talk about, is working from home, which obviously during the COVID period we were all forced to do. What's been interesting in the UK is that the return to work has been slower than perhaps in many other countries. Certainly the stats demonstrate that working from home has taken hold. Many companies have been reticent about bringing their teams back into London or forcing them back into London. And we can see the impact on passenger movement. So for example, in our suburban trains, passenger levels are still at only 80% of where they were pre-COVID. And to a degree, we can see that in the streets of London. Mondays and Fridays are definitely quieter than they were pre-COVID.
But that is good news, isn't it?
I think it's good news for those who are coming to London for play, because there's more space on the pavements and you can get into restaurants on a Monday and a Friday.
Definitely.
But for the operators, for the F&B operators, and for many office occupiers, they want their teams in. They want the face-to-face meetings. They want the camaraderie that working together produces. And working from home can damage that over a longer period.
David, are there any current opportunities in the current slow markets for commercial properties in London and other major cities?
Isabel, I think that's a really good question to ask today. We have seen quite dramatic valuation falls. So prices have fallen across most commercial properties in London and provincially. So the question I think we need to ask ourselves is, have those valuation falls stopped? Have values stabilized? And do we see a time when they might rise again? So
what do you think?
There is a strong correlation between property prices and interest rates. As interest rates rise, property values naturally fall. Investors can do more with their money elsewhere. They don't need to buy property, they can put it into the bank and get 5 or 6% income return very safely and very securely. As a consequence, property values have fallen. Now though, with interest rates stabilising, and we hope falling next year, it's a really good time to re-examine opportunities in the commercial property sector. Our belief is it's now a really good time to buy income-producing assets at a substantial discount to where they were a year or two ago, enjoying that income flow and looking forward to a time when interest rates fall and commercial property prices rise. Within the Consulco group, we're now looking very carefully at commercial property opportunities both in London and provincially.
That's interesting, David. But would you highlight London or other cities?
So we always favour London, and the reason for that is that the depth of demand is always strong in London. So that's important because not only are there lots of assets that can be bought at any one time, but as importantly, perhaps more importantly, when one comes to exit, when one comes to sell, there's a strong depth of demand. There are always investors looking for assets in the London market. Having said that, both Birmingham, Leeds and Manchester offer really interesting opportunities at the moment. Those three cities have suffered less working from home. They have seen a stronger return to work from office workers and haven't been impacted quite so much by rising interest rates. A lot of the top end of the London property market is underpinned by international buyers, overseas investors. And with travel still tricky, certainly until 6 or 9 months ago, those buyers were just not in the market. In addition, we've had further tax changes which makes London residential property less attractive to international buyers. And the consequence of that, plus rising interest rates, has been really a fall in residential property values, certainly until 6 or so months ago, but with the prospect of growth in capital values coming over the next year or two. We take our research from people like Savills or Knight Frank. They're all forecasting a difficult year this year, with values flatlining or declining across the UK, but with a little bit of recovery next year and then stronger in 2025 onwards.
Which investment sectors or regions are currently considered hot in the UK?
Well, I think you'll have gathered from my previous comments that at the moment, the commercial property market is going through a period of stabilisation. So at the moment, we're seeing few buyers, not many opportunities because vendors are not selling into a quiet market. And it's really difficult to identify hot locations or hot sectors. It's been much easier in the past. So from 2010 to 2015 or 16, it was food and beverage, and particularly in central London, particularly in Soho. From 2015 to 2022, it was what we would call beds and sheds. By that I mean, let's take beds first of all. So the bed sector encompasses hotels, nursing homes, student accommodation, hospitals. So anything related to that has shown strong rental growth and strong capital returns. And by sheds, we mean distribution warehouses. We haven't really touched upon home shopping and the impact on the property market, but it's had two direct impacts. First of all, there has been a hollowing out of town centres. As less people go in, as less people spend money in town centres, the number of shops that can survive fall. And we've seen some big casualties over the past 3 or 4 years, particularly department stores, which are perhaps large and unfocused in what they do, people preferring instead to go to specialist stores or buying online. So that's the first impact, a reduction in retail floor space, or a reduction in the demand for retail floor space. The second has been the need to provide accommodation for both the giant parcel companies and suppliers like Amazon or DPD, both for their huge distribution warehouses, which are usually located at motorway hubs, but also with last mile distribution centres. So these are smaller sheds located on the edge of city centres where the big articulated vehicles drop their loads, and it's transferred then onto vans or onto motorcycles for last mile delivery.
And in contrast, what sectors should investors approach with caution due to limited demand and potential high refurbishment costs?
Isabel, I think we're particularly concerned about the office sector. So we've talked at some length about working from home and the impact of that on office demand. I think with offices we can certainly see a strong two-tier market emerging. So the very best buildings, brand new, strong green credentials, which offer additional facilities like gyms or cafes, etc., continue to command top rents. But many office buildings, or most office buildings in fact, have, we think, a limited life.
How come?
With the government focused on ESG credentials and, to be honest, occupiers as well, there is a real need to ensure that office accommodation provides such green space. That will mean many buildings, most buildings, will require substantial refurbishment over the next 5 to 10 years, and much of that refurbishment cost is not priced in.
And what sort of refurbishment?
We're particularly talking about plant and machinery. So we need to get rid of all gas boilers. We need to look at all of the air conditioning. We need to ensure that all the windows are double glazed. We need to ensure that there's as little carbon produced as possible. Now, this is important for the building owners so that they meet their green credentials, but also, as we're seeing more and more, the office occupiers, particularly the big corporations, need to demonstrate to their shareholders and to their staff that they share this green future, the ideal green future. And for office occupiers who are struggling to get staff back in, demonstrating their green awareness is one big tick in the box. Look, guys, come back to the office. You're going to have a lot more community space. We're going to provide you with a gym, with showers, with bike racks, and the building itself is super green, super efficient.
Well, that sounds like great news.
It's great news for those buildings which provide that space, but as we look around, we're here in Soho Square, I would say 90% of these buildings don't provide that accommodation. And it's that cost of improving the accommodation which is not factored in, which I think will damage building values and their growth prospects in the future.
David, thank you so much for your time and for your insights. It's been very helpful.
It's been my pleasure, Isabella. As I said, the property market's at an inflection point. It'll be great to update you again soon.
I'm looking forward to it.
Perfect. Thank you.
Thank you.